Hello and happy Feb 27th. Another week, more green and some new records. This week, it's another annual all-time high in Bitcoin. We're now at a level not seen since November 21. And we're also setting some records in the ETFs and also on Coinbase's international exchange, which saw $1 billion of volume multiple days last week, which is great to see. We're going to discuss this, how we got there, and what the path forward looks like throughout the show. But talking about all-time highs, Greg, you and I were on a call with a client yesterday, and there was a mention of potential all-time highs in Q2. I must admit, I was a little bit skeptical, but I'm ready to be proven wrong. I'm curious how you're thinking about it now, given the move overnight.
Yeah, Ben, I was a little skeptical as well, though, this move up through 57,000 has taken a lot of us by surprise. So it does look certainly possible that we could see new highs sooner rather than later. However, one thing to keep an eye on is positioning is starting to look stretched. Open interest is, far above its, say, 6-month average, and funding rates are, into the 20-30% range on a lot of tokens, which makes it very expensive to hold long positions. So while I hope we do see new highs soon, it wouldn't surprise me if we take a little bit of a breather in the next few weeks.
Yeah, I think that's fair. Things don't go up in a straight line, but we shall see. Now, onto the show. George is out today and Josh is on pat leave. I'm wishing him the best and hope he's listening in and getting some rest. But we're going to do the market section ourselves here in a slightly different way, bringing lots of people in throughout the conversation. As well as that, we have all the normal parts of the shows. We've got David covering macro and research, where he's going to be speaking through his recent note on USDC and also an update on Decoding. Sid's going to run us through an update on Farcaster, who continues to ship incredibly quickly. Greg's going to run us through some flows and positioning. And then we also have a very special guest today, Shiliang Tang, co-founder and president of Arbelos, a crypto trading firm. Shiliang is a crypto OG, having bought his first Bitcoin in 2012. And him and his partner, Josh Lim, have probably traded more crypto derivatives than anyone else. So great to have him on the show. But before we get started, we have got many of the team at ETH Denver this week, the base team, institutional team. So if you are there, please reach out to your contacts at Coinbase. We are holding a number of events and there's a number of ways of getting involved. So please reach out. And lastly, for those watching on YouTube, don't forget to scan that QR code to access all of David and the team's fantastic research. If you're listening on podcast, that will be in the show notes. And lastly, don't forget to like and subscribe no matter what platform you're on so that more people can hear about the call. Without further ado, Shiliang, welcome to the podcast and welcome to 57K Bitcoin.
Yeah, thank you so much for having me. Big fan of your show, big fan of your company. So really appreciate the invite.
Cool. Well, thank you. Very good to have you here. And I know it's a busy day, so I appreciate you taking time out. We'd love to get started with your journey into crypto. As I kind of intimated at the top of the show, you've been in crypto a while. Can you just kind of give us a quick skinny on your background?
Yeah, I spent most of my career in traditional markets on the high frequency trading, algorithmic trading side of things, focus on like options, volatility trading. I first heard of Bitcoin in like 2012. I had a couple of friends, went to a technical college. So I had a couple of friends who were mining it. And then being on a trading desk, you tend to hear of things, especially speculative things that go up, 500, 1,000%. So around that time, like 2012, 2013, you had that massive like bull market right before Mt. Gox. So that was my first foray into crypto. Just kind of dabbled it in my PA, post Mt. Gox, things were kind of dead for a while. But in 2017, the next kind of cycle when it was a bit more mainstream, launched Ledger Prime. Ledger Prime was part of this holding company called Ledger Holdings. But effectively, we were a multi-strategy hedge fund in crypto, focused on a variety of like quantitative strategies mostly. We had the unfortunate fortune of having been acquired by FTX. And so that entity was part of the bankruptcy there, wound that down. In the last year, launched my new venture with my co-founder, Josh Lim, who used to be the head of derivatives at Genesis. and Galaxy previously. And so Arbelos Markets, is focused. It's a principal trading firm. Mandate's broad, do a variety of trading strategies, but really focus on the derivatives markets, especially the options, both electronic as well as like the OTC bilateral markets.
Perfect. Well, thank you for the intro. So you started your journey at 2012. Market structure then must have been very, very different to what we have today. And as a man who's come through the ranks of kind of HFT firms, I'm sure that's something which you're acutely aware of. Do you mind, I guess, just maybe giving us a quick overview of like how that market structure has changed and maybe some of the things you can do today that wouldn't have been vaguely possible even just a few years ago?
Yeah, I would say it's changed, but it kind of like history tends to repeat itself, and it's come back in various flavors that resemble what we kind of saw in the past. Obviously, 2012, 2013, there were only like a handful of exchanges, right? I think that the main one was basically Mt. Gox. Funny story was, I managed to get most of my assets off of Mt. Gox. And I moved it to Coinbase at like a 10 to 15% discount just to get it out of Mt. Gox. So that was a interesting story, and thanks to Coinbase for being able to accommodate that. But I think like even when we first launched Ledger Prime in 2017, one of the easiest strategies was just exchange arbitrage, right? You could literally point and click and move assets around and trade and be able to monetize that. Obviously, the markets have gotten way more efficient. But I'd say that history kind of repeats itself because we're kind of seeing that a bit. We have seen that a bit in DeFi, where effectively obviously the centralized markets have gotten way more efficient, but in DeFi, like cross-chain, various protocols, derivatives protocols, CeFi, DeFi, there's sort of like ample arbitrage opportunities in spot markets as well as derivatives markets. So even though like the CeFi market's gotten more efficient, the kind of proliferation of like DeFi markets now, where you have like an infinite number, it seems like an infinite number of like L1s, L2s, and kind of the same like lending, spot, AMM, derivatives markets, GMX style like market, like and across like all these chains, like it's causing a lot of still like fragmentation, dislocation. So we can kind of run the same strategy we used to, just in a different, like slightly different format.
Well, first of all, amazing to hear that Coinbase was here to help you through Mt. Gox, and great to hear Brian and Fred were able to help there. So that's great. Second, you mentioned how kind of history rhymes and repeats itself. I'm curious, if we look at the move that we've had over the last few hours, few days, it's obviously been aggressively moving higher. How much do you think derivatives have factored into that performance in the last couple of days and weeks?
Yeah, I would say it always plays a part just because like the leverage and how much larger derivatives markets are. But I would say like the vast majority of the move has been driven by like spot markets as well. Obviously, like pure spot demand via like ETF inflows. On the Bitcoin side, there's no denying that. You can see in the metrics the growth of the various ETFs, the volumes that are traded. You can kind of see it in terms of like Asia market performance versus like US market performance. In certain days, it's clear that it's very, very US driven, and US market open and close like those hours to play a huge role now because of the ETF. So that's there's no denying like how much the spot market, how much demand there has been in the spot markets. On the derivative side, it's been you can see I would say dislocations, especially looking at like Deribit versus some other derivatives markets on the linear side. I would say it's been generally one-way flow, at least for us, on the OTC side, and then as a result, when we hedge our risk, on Deribit. And by one-way flow, I mean it's generally been like call buying, right? And so like if we're selling calls and then buying calls on Deribit, someone else is selling the call. And so like generally because dealers, I would say, have been short like gamma, perhaps like on the upside, we have to delta hedge it. And sometimes you'll see like pretty large dislocations in like Deribit, like perp markets versus like other perp markets, especially on large moves or when you're going through like short strikes and large short open interests. Just because it's dealers hedging or like overwriters hedging, So it actually causes like a fair amount of like dislocation. And so like, because like, options markets generally, like I would say people have been like positioned long on Bitcoin and ETH. That certainly has like caused added like fuel to the fire in terms of just driving like additional upside from dealers and overwriters hedging.
Yeah, thanks for that. So it's interesting that most of the flow is one way and long biased. We hear quite a bit about this large ETH overwriter, potentially out of Asia. What can you tell us about that? How important is his or her positioning, and is it something you keep an eye on?
Yeah, he played a huge role, I would say, last year, like last summer, last fall, when markets were way quieter and vols were a lot lower. There weren't much activity, and so he dominated like the ETH markets. Dealers were massively long gamma as a result of this large ETH overwriter. And it caused, generally, I would say, the market traded like it was long gamma, right, from the dealer side. And so like, anytime you get like a move up in ETH, it'd be heavily sold. Vols will get heavily sold every time there was like a spike. But that started to change, I would say, like end of last year and this year when the markets really started to run up. ETH started to grind higher, started to move through his strikes, causing him to like cover. And I think also just like there was so much attention being paid to him by the market participants that, people could figure out because he wasn't trading OTC or, doing it in block RFQ on like Paradigm and these like platforms. He was literally on the order books, trading it. People could figure out like what he was doing, when he was doing it, what like his positions were. And so like once the market like sniffs that out, I think it definitely puts him or her at a disadvantage, and so there was a bit of a squeeze, right, for like some of his positions as the market started to move higher, especially in ETH. So he covered a lot in the last year. He came back, I would say, post ETF approval when the markets seemed to be a bit softer. But he's since had to cover, and obviously we've run way through all the overriding strikes, and so we haven't seen him come back to sell anything, which could explain why like ETH vol is the kind of like cap in terms of like the vol, the ceiling on the vol and ETH has almost been lifted, and obviously ETH vols are way up than a month, 2 months, 3 months ago, and so we haven't seen him come back just yet.
Interesting. So I guess could we take away from that this latest move in ETH wasn't driven so much by either him or some other dealer flows, but rather from spot market positioning? Is that fair?
Yeah, I would say it's finally ETH's turn. It seems like it took a long time. We saw a lot of bullish positioning for ETH. All through last year into the ETF. I think like post ETF, a lot of people were thinking that like finally a lot of the capital might flow from Bitcoin to ETH. It took a bit of time, but I think like this latest leg was probably driven by Uniswap and kind of the re-rating and like DeFi across the board. And so it seems like the ETH BTC ratio is kind of like found a floor at like 0.05, and so we're hopeful that like the narrative now is shifting to like the ETF approval for ETH. Possibly it looks like in May. Whether that gets approved or not, I don't know, but obviously the whole market's like very narrative driven, and so there's no outright rejection until then. I think the narrative definitely will be kind of focused on that.
Yeah, you're so right. The whole space is so narrative driven, and right now the narrative seems to be around Bitcoin and Ethereum. And I think when we talk about ETFs specifically, while ETH is coming, it feels like from the conversations we're having, Bitcoin is definitely ruling the roost here, up 10%, 10.4% on the week, and BTC dominance is also kind of strengthening as well. Greg, I know you've got a chart on that. Do you want to kind of just run us through that chart, and then for those that are listening, maybe just kind of talk through what it's showing?
Yeah, so if we could bring that chart up. BTC dominance is something we keep a close eye on. Essentially, you can think of it as, how is Bitcoin performing vis-a-vis the rest of the crypto market? We've seen dominance rise basically throughout the year, which really makes sense given, in 2023, Bitcoin owned the narrative with the ETF, and it's more or less continued to do so through the first couple months of this year. Now the question comes up is, will this continue, or, will ETH start to outperform? And, from my view, it wouldn't surprise me if we continue to see Bitcoin outperform. The reason is Bitcoin now has access to a massive amount of capital, being the traditional asset markets, whereas the rest of crypto is really still just the focus of crypto native funds. And what it looks like is happening to us is you're seeing massive inflows into the ETF. That's helping drive Bitcoin higher. And then in the rest of the crypto markets, it seems like people are just trading around different sectors, because we'll see, one sector or narrative outperform and another one underperform. And that cycle sort of just continues to repeat. So until we get, significant new capital coming into the spot markets, or a potential ETH ETF, it wouldn't surprise me if we see Bitcoin dominance continue to rise, upwards to 60%.
Shiliang, I'm curious, you've been in the space a long time, you've seen BTC dominance far higher than where it is today. Like, how do you think about that as a metric when you're assessing whether it's risk in the space or fear or greed, et cetera?
Yeah, I think it's historically it's been very it's kind of like psycho-driven, right? I think like the halving. This time around it's been a bit different with the ETF, but generally I think we've seen like Bitcoin dominance kind of peak right up until like the halving, and then like you kind of get like over time like when like Bitcoin kind of softens or flatlines a bit and volatility comes down in Bitcoin, you start to see that rotation into alts. You get this like next leg of the bull market, which is driven by ETH and other kind of like coins. So we could see the same thing, right? Where I certainly wouldn't be surprised if going to the halving, Bitcoin gets like another leg, close to all-time highs, and then like into the halving, you get some like profit takers and more of like the same kind of like rotation. So I think as all of you alluded to, I think we all agree that we're in the middle of this bull market, and so it's really more about like capital rotation and whatnot, and so I think for me it's basically just focusing on how that capital will kind of rotate from Bitcoin into like the other parts of the market.
That makes total sense, and I agree with kind of Greg's point earlier around the kind of like the difference of flows this time around. Like, we've never had such a demand from a new investor base in this way, and it's very, very hard to kind of predict when that might end. We're going to touch upon ETFs a little bit more later, we can discuss it further. But
it kind of reminds me, just quickly, like kind of reminds you of when, I don't know if you remember, post-COVID crash in March, when the market started to recover in like April, May, June, July. Like Tudor Investments got into the space pretty aggressive back then via like CME futures. And that was like, large institutional investor, like got into the space and kind of like pushed up the like demand. So it kind of like reminds me of that period a little bit. Tail end 2020, where like there were certainly some institutions that really got into like Bitcoin and the ecosystem pretty aggressively, during COVID. This period definitely reminds me a little bit of that.
Yeah, that makes a ton of sense. We're in the middle of a lot of that flow post-COVID, and there was definitely a new type of buyer coming in size that we hadn't seen before, and it definitely are some similarities there. As we're going to move down these charts, we look at ETH's performance on the week. At one point, ETH BTC was up 7.5%, and now it's kind of broadly flat on the week. David, we'd love to bring you in here. You've obviously been publishing on ETH. You expect it to recover. I think you're on the way to Denver today, which is going to be an amazing conference. So I'm curious, how are you thinking about ETH and the performance this week, and maybe versus BTC going forwards?
Yeah, I wrote in our Crypto Market Outlook 2024 that I wouldn't necessarily be surprised to see ETH BTC break to new local highs here. And I think that ETH definitely has a chance to catch up to his peers after underperforming since the beginning of fourth quarter of last year. But of course, a lot of that still depends on the size of the BTC inflows, which is still kind of limiting that move somewhat. So it's not to say that, as you mentioned, ETH isn't doing well. It's just that every time it tries to outperform a little bit, we see that kind of catch up, and it's still kind of neck and neck at this moment. So I wouldn't be surprised if it still kind of chops around the ETH BTC cross inside of this range. But certainly, I think that the growth of the Ethereum DeFi ecosystem has been a big part of the story. I've been seeing a few research notes out from other firms, not ourselves, who've been kind of talking about the Dencun upgrade, for example, being responsible for this. I would kind of push back on that idea a little bit. I do think that the Dencun upgrade is meaningful, but it would tend to be somewhat dilutive to Ethereum mainnet insofar as it's making the transactions on L2s a lot cheaper. But still, it's going to be hugely important because I think 4844 is still the big one as far as the upgrades or EIPs that are included in the Dencun fork. But I would also look to what's been happening with a change in the churn limit for Ethereum as well, because that's going to reduce the amount of validators who are going to be able to be accepted per epoch. And I think that when you see that change from 13 to throttling at 8, I think that's going to be important because right now you're seeing a lot of people, a lot of validators in the entry queue, or potential validators, I should say. So I think that it's showing you the amount of activity that is really there. A lot of that has to do with restaking, eigenlayer, the potential for having liquid restaking tokens, for example, and the leverage in the Ethereum ecosystem. You were seeing it pick up right now. So I think that for me is what's very meaningful. And that's the fundamentals behind this move in Ethereum in my mind. So I would look to the Dencun fork. That's going to happen on March 13th. And if you're keeping track, that's epoch 269568. If you don't want to remember that, it's around 2 o'clock Universal Coordinated Time.
Okay, 2 p.m. March 15th. I think that might be what most people remember versus the the exact epoch. That's super helpful, David. Shiliang, David mentioned restaking there. It's obviously been a pretty important part of the year so far. I kind of look at that a little bit in the way of some of the excitement around ICOs in 17 and DeFi Summer and to some extent Deepin and other things that we've seen that have really captured people's attention from a narrative perspective. Like, how do you think about restaking? And are there any risks or concerns that you're kind of trying to think out there?
Yeah, I think, there's the argument about restaking, whether the same as reapplication. We're starting to see some interesting structures in DeFi broadly, even on the option side as collateral. So like we've seen some use of like Uniswap LP tokens or like GMX Delta neutral strategies, like basically like these Delta neutral or obviously staked ETH, but these like generally I would say safer or Delta neutral structures in DeFi be used as collateral for additional trading, right? So like using like those kinds of collateral as collateral to do like a cash carry trade or, for example, like a Uniswap, like ETH, USDC pool, liquidity position as like collateral to sell like additional, call options on ETH, right? Like generally that's pretty liquid in most normal environments. And so we're okay to take that as collateral in obviously small sizes. So that's been an interesting development. On the whole restaking side, right? Obviously like Pendo has, contributed a lot to that space in terms of like, PTYT, kind of positioning and speculation around like, the yield they can generate from like, eigenlayer points and staking versus just like a fixed yield they can get up front. That's been pretty interesting. I do think like it does cause issues, and I joke around with kind of colleagues on this. It's kind of like tail end bull market / bear market problem. So like it's probably not gonna be a problem in like the early days of a bull market when prices keep going up and things are fine. But when the market starts going down and liquidity again becomes like an issue, I don't think that the whole ecosystem necessarily has been tested yet in this format with like restaking and reapplication. in the past. And so I wouldn't be surprised if like in a year or two, we're getting to the tail end of this bull market or bear market. And, we hit another like liquidity crunch like we did in the past, and certain parts of, this ecosystem, gets hammered, right? I think that's definitely not out of the possibility. People will chase yield, people will speculate, like markets go up, people will chase, markets. It's just human nature. So, I think definitely wouldn't be surprised.
Yeah, we were joking just last week on the call that people will always find ways of increasing return or increasing risk in the space, and just looping strategies, as we've seen many times over. It's as if a 50, 60, 70-fold asset wasn't volatile enough, and returns of like north of 6-7% weren't high enough. People will always find a way. But David, I know you've been very close to the restaking side of things, and obviously Ethereum. Like, curious for your thoughts here as well.
Yeah, I mean, this is an important theme that I don't think should be overlooked, because certainly it's very reminiscent of like DeFi summer, back in 2020. And I think that it could probably generate the same kind of interest. But we kind of talked about the risks last week. If you didn't listen to that, I think it bears repeating that, like the idea of restaking itself, especially if you are a validator putting that money in, like there's a non-negligible risk in terms of slashing that is involved here. Like oftentimes when you are just staking as a validator, for example, like it's very de minimis in terms of what you're actually potentially losing if you aren't fulfilling your duties. But here, if you are tying that yield to an actively validated service, for example, as part of the restaking elements of this, there's a potential risk on this side. So I think that is raising some concern within the community about leverage that's being taken on. Like if you have a liquid restaking token on the back of that, leverage upon leverage, what happens if there are any potential failures of these AVSs? So that is something that I think we need to be paying attention to. I don't think it's an immediate risk right now. And certainly I think we still need to see this kind of happen to kind of play out this experiment to understand what's going on. But that's just something that I would like to repeat.
Yeah, thank you for the PSA, David. I'm fully with you both there on the risks. Now, moving on to some of the other movers, DeFi Pulse Index up 20.57%, Uni up 44.3%. We'd love to bring Sid in here. We obviously had a bit of an update from Uni Swap Foundation last week. And then Uni is a large portion of the DeFi Pulse Index, I think somewhere between 30 and 40%, which is why that's moved higher. But Sid, over to you. What was announced, and how should we be thinking about it?
Yeah, it was a pretty aggressive move. Came off the back of a governance proposal from the Uniswap Foundation, which suggested upgrading the protocol's governance and effectively rewarding Uni holders who stake and delegate their token for governance with a percentage of fees from the protocol. So this is, has a pretty significant effect on Uniswap if it does pass, of course. What's notable about this is that there's been many attempts at turning on the proverbial fee switch for Uniswap in the past from several different proposals, and none of them have really passed the final on-chain vote, and several haven't passed the temperature check either. So there's kind of two stages for this to actually finally get implemented. There's first a temperature check, which is kind of a preliminary vote, and then a final on-chain vote, after which it'll get executed. And what's, I think, different about this one is it's come from the foundation themselves. There's been some chatter around potential regulatory implications of this, and the fact that it comes from the foundation signaling some sort of positive sentiment on that front. But yeah, obviously it's had a follow-up impact on DeFi as a whole, on the index as a whole. Uniswap being the biggest component of the index, but others like Comp and Aave and others in the ecosystem, the original kind of quote-unquote blue chip DeFi, have all been rallying as a result of this.
And with the others there, are they just running in sympathy? There's nothing necessarily new about what Uni might do that affects them. It's really just in sympathy with they're all moving higher. Is that fair?
Yeah, that's pretty much fair. No new announcements on those fronts.
Interesting. Yeah, I have to say it's I definitely admire the Uniswap team and foundation. Like, always been amazing interactions with them. So interested to see kind of why, understand a little bit behind like why they did this now, but I guess that will come to light in the coming days, weeks, and months. Moving on, other movers, STX. Dave, would love to bring you in here in the Bitcoin ecosystem. We're still getting a lot of interest there, both in ordinals and other ways of using the Bitcoin blockchain. What's been going on there specifically?
Yeah, I think like stacks and layer twos on Bitcoin have gotten a lot of attention recently. And I think a big part of that has to do with the ETFs really kind of translating interest into the broader Bitcoin ecosystem. But of course, that really highlights ordinals and NFTs, which, you know, have been one of the more meaningful kind of use cases, quote unquote, for the Bitcoin network itself. We are seeing a lot of infrastructure being built out there. I think more recently as well, there's been this key event, the Building on Bitcoin Hackathon. That's going on right now. I think it lasts until March 7th. And I think this is also kind of driving the activity and attention around stacks in the very short term, because right now participants are taking their turn to actually build using Clarity, which is a programming language to create the smart contracts on the Bitcoin network. So this is part of the Stacks 2.0 kind of idea. And some people have claimed that it's actually easier to use than the Solidity on Ethereum. So I think that this is kind of what people are seeing. Of course, we won't really know what will materialize from this until maybe a few weeks from now to see how these things fare and whether this is going to generate any real organic activity on the network.
Interesting, yeah. Encouraging to see people continue trying to innovate there. Also, we would love to bring in Greg now to talking through some of the meme tokens. And sorry, Greg, not to say that you're an expert on memes, although I'm sure you probably could do some very good memes should you wish. We've got Pepe up 81%, Floki up 41%, Dog with Hat up 48%. I looked at that earlier on when I was putting the stats together, and I didn't realize that Dog with Hat had a $550 million market cap, which was bigger than Floki. Anyway, what does that say about the market, Greg?
I think what we're seeing here is, we're clearly in the middle of a bull market, or in some part of the bull market, and people are getting very excited. And we know these meme coins in the right market, if you're lucky enough to be in the right one at the right time, can produce some pretty spectacular returns. So I think that's why we're seeing these outperform. That being said, this is still very much a crypto native retail part of the market. We don't see really any interest at all from the more institutional groups.
Yeah, that's still a part of the market I have no idea about, and I would love to be able to pick that next 1000x. Sadly, I do not have that skill. And then lastly, just finishing off on Gala and Illuvium, we had a new release from the Gala team, which put their token up significantly, and it feels like Illuvium has rallied in sympathy with that as well. But great to see some of these Web3 games coming online and people getting kind of starting to see traction there. So that is very good to see. Now, moving on from there onto ETFs. So I will, for those that aren't watching on YouTube, we're showing here a tweet from Eric Balchunas, one of the ETF strategists at Bloomberg, saying it's official: the new 9 Bitcoin ETFs have broken all-time volume record today with 2.4 billion, just barely beating day one, but about double their recent daily average. IBIT went wild, accounting for 1.3 billion of it, breaking its record by about 30%. So we mentioned records. That is one of the records that we're seeing in the Bitcoin ETF space. Greg, maybe we can hand to you to give a bit of an overview of what we've been seeing in kind of flows in the last week or so.
Yeah, so flows into the ETF continue to be very positive. Let me just pull it up so I can give you the latest numbers. In the last week, we've seen $1.1 billion move into these products. Since they've launched, over $6 billion net new money into these products. So, really strong flows, and we're seeing consistent flows in the hundreds of millions of dollars. So, just a really healthy sign from the ETF market. The other thing that's really important to keep an eye on is the outflows out of the Grayscale product. That product has seen a number of outflows just because it's the highest cost ETF. However, we're now seeing those outflows really slow to a trickle. Yesterday, just over 22 million came out of that product. So, that's another really healthy sign that, that's starting to find a balance. So if you couple that with, the net inflows, everything from the ETF side, looks really good. And then that tweet you just had, we talk about flows coming into the market, but then there's also just the volume being traded back and forth among equity traders or ETF traders. And that tweet said, we're at very high volume levels, which just goes to show the interest in these products, which is, again, a very positive sign for the market overall.
Yeah, I totally agree. I think what's great about these volumes and AUM numbers is that a lot of the wealth management platforms are going to have benchmarks which ETFs can be allowed onto those platforms. Some of them will be AUM based, some of them will be volume based, and then there's a kind of a time based one as well. And from speaking to an expert this morning, they said that from a volume and AUM perspective, these ETFs are kind of blowing through way past expectations, which means they should be able to get them onto the platforms. And then typically the platforms take about 90 days to bring them on. So we're kind of halfway through that period now. So if we're looking towards the sort of end of March, we might have a lot more demand for these as well, potentially. So yeah, all exciting, going in the right direction. Shiliang, would love to bring you back in here. As you kind of look at this ETF data, I'm sure you're looking at it day by day and making sure you're on top of it. How does that affect your day-to-day?
Yeah, I mean, I touched upon it a little bit, but like we're seeing just a lot of call it like intraday, quote unquote seasonality, right? In terms of like flows, in terms of like price action, volatility, generally around US Open, it gets like pretty volatile. And like a lot of I think people have picked up on it as well, but people are like generally positioning like how they're trading like options, like trying to time it into the US Open markets, or US closes. And so like that's kind of affected things, quite a bit. Just because like what we're seeing, because the ETF is a US product and generally inflows happen like US markets hours. That's kind of like affected like vol markets, Asia versus Europe versus US.
Interesting. So are you saying that as the US opens, like vol picks up a few points as people look to buy calls, presumably expecting inflows and prices to move higher during the day?
Yep.
Awesome. Thanks, Shiliang. That's some super interesting insights and one to keep an eye out for. So before we move on to David's section for macro and research, a couple of other tokens that have been moving. Obviously, post NVIDIA last week, we continue to see strength in AI-related tokens, Render, Akash, etc. One thing to note as well on Akash, we added that to our roadmap for assets that we may potentially add, as well as Ronin, the blockchain network developed by the Axie Infinity team. And a quick reminder, Akash is a decentralized cloud computing marketplace. So somewhat a little similar to Render in some ways. But with that, I mean, we've had a lot of moves, a lot of green, which is always nice to see. But let's go to David for macro and research. And David, as always, we're happy to hear the other side and hear some of the risks that we should be looking out for. Because on days like today, it's obviously easy to get drunk on the move higher, but I think it's also important that we do have balance to it as well.
Yeah, this was part of the view that we had in early February. And if you didn't see it, we put out a piece called Constructive Outlook. So pretty clear on what we meant by that. And we thought that would last at least through the end of February. But I said that we would be somewhat concerned about some of the seasonal factors kind of creeping in March. Now, that said, I think from the macro kind of point of view, a lot of market players have been worried about the Fed delaying rate cuts, for example. Some of the overvaluation we've been seeing in traditional assets like stocks, potential inflation risk to the upside. And to be very clear, we pushed back very hard on those views. Like we thought that this idea of the Fed delaying rate cuts was overblown. Certainly, like the idea of doing March cuts, we didn't really think was in the cards anyway. So pushing them back to like, say, May or even slightly later by a month or two doesn't necessarily worry us. And we definitely believed in the disinflationary trend that we're seeing at the moment. So in our view, the soft landing is here. It should be priced into assets. And this is kind of what we're getting. Now, that said, I think that part of the move we're seeing in some of the tech assets, like tech stocks, like Nvidia, for example, have translated somewhat into the flows that we've been getting into crypto as well. Certainly on the AI related theme, but I think also people are kind of playing this as, you know what, risk is on. Let's kind of put into some of these assets. And granted, I don't think that something like Bitcoin, for example, operates exactly like a stock. I definitely don't. I think it has elements of like, of commodity and FX and equity and, to some extent, all these assets kind of combined. But I think that this is supporting some of the price action we've gotten in tandem with the ETF flows. But this week, we're going to get fresh data on new home sales, for example. So that's going to be worth watching. But I think overall, a lot of people are going to be talking about the core PCE number that's going to come out on Thursday. It's going to be important because, of course, this is what the Fed looks at. But quite honestly, I don't think it's going to change the situation too much. Again, look at my view on what I see for disinflation and the secular trends there. But I think that probably this is going to be what's very key right now.
Thanks, David. Shiliang, curious, obviously you've been in the space a long time. How much of an impact does macro have today versus 5, 6, 7 years ago with regards to the direction of travel the space has?
Yeah, it's I would say it comes in flows. I would say 10 years ago, probably nothing, right? It was very idiosyncratic, crypto native. It comes down to how much cross-pollination, cross-exchange of capital is between traditional markets and the crypto native markets. I would say end of 2021, 2022, except for the idiosyncratic shocks to the crypto ecosystem in Three Arrows and FTX, et cetera. I would say there was a lot of cross-pollination, right? A lot of traditional firms like the Tiger Globals of the world, et cetera, got into crypto. And so when those kind of firms have a lot of their assets in traditional markets, but also in crypto, then obviously what happens in the traditional markets and macros will affect how they position the crypto holdings. And crypto obviously is a long tail asset in terms of the risk curve, right? And so when it's broadly risk off, we definitely saw in the macro world, we definitely saw crypto come off as a risk asset, right? In 2022 when rates were being hiked and inflation and whatnot. But I would say right now it feels at least I would say second half of last year, early this year, it feels pretty idiosyncratic in the sense that because of the ETF, there's just a ton of inflows. Obviously the stock market has done well. Even though rates have kind of the rate cut expectations have been pushed back. Generally, that doesn't seem to be affecting crypto markets right now. But as more traditional capital, traditional retail capital and institutions get into the space, I would expect crypto to become more and more correlated again to the general macro markets.
Thanks, Shiliang. And David, I want to go back to one comment you made earlier on around seasonals. It's something that we've spoken about a lot in the past on the shows, but what are we coming into in March in terms of seasonals, and how should we think about that for the next few weeks or so?
Yeah, I think that's a good point, Ben, because so I did mention that there tends to be some seasonal factors that occur in March, and it tends to be a very important month for traditional finance. And there are certain reasons around that. I think tax payments are probably the biggest factor because people tend to take some profits in order to pay the taxes that they need to going into April, if you're in the United States, for example. I also think that there's other factors like automatic retirement contributions that need to be considered. Also, payments, I think there are activities around government projects, big enterprises that need to contribute, for example. So I think that when we see those things fade, that tends to kind of take the gloss off of traditional markets somewhat. And I think that we are kind of connected to that in crypto. Now, some of those factors I think probably don't mean quite as much to our asset class. But certainly if the flows are going down overall, I don't think that's very helpful. So that's something just to kind of keep in mind as we get into the March period.
Thanks, David. And we'd love to move across now to your USDC report that you put out recently. Do you mind just running us through that at a high level?
Yeah, thanks, Ben. So we just published this report called The Resurgence of USDC. And the idea behind it is we have seen that stablecoins as a whole have actually had quite a big recovery over the last few months. And if you recall, we saw a pretty steady drop in the first 3 quarters of 2023. Now, the last I checked, the market cap of stablecoins is at $140 billion. So that's actually surpassing the number that we started with in early 2023. Now, within that, I think that we have seen the mix between USDC, Circle's USDC, and Tether's USDT kind of change. Certainly, Tether has taken the stronger position inside of the total stablecoin market cap. It's currently around 70%, 71% of the total total stablecoin market cap. But we are seeing that USDC has actually gained very sharply over the last few months. So the supply of USDC has actually increased by around 14%, probably a little bit over than that right now, since the beginning of December 2023. And comparatively, Tether actually only increased around 8 to 9%. So still an increase, but we've seen a much sharper increase for USDC, in part because we are seeing a lot more usage there. And this kind of goes into the story that we've been talking about today with regards to the increase in leverage bets and perpetual futures. For example, you are seeing that as a representation of that market, which represents around 3/4 of all the trading volume on global centralized exchanges, we are seeing that USDC now represents somewhere around 3% of perps volume. Doesn't sound like a lot, but that's still around a 5x increase from the beginning of 2023. So it's the direction of travel that I think really matters right now. So I think Tether still, of course, represents the lion's share of the volumes or activity on perps. But we are seeing that right now, because of certain important factors, with mainly having to do with the ETF, spot Bitcoin ETFs, I think that you are seeing that the usage of USDC is growing. So I think that's really the key takeaway of that report.
Yeah, and it's worth mentioning that INTX, Coinbase's international exchange, has had a couple of days last week with north of $1 billion of volume, which is great to see. And the team there are doing a great job shipping. David, I'm curious, why do you think we are seeing an increase in usage?
Yeah, I think that's a good call out to Coinbase International Exchange, Ben. And I think that when that was launched in May, certainly that was very supportive, or May of last year, was very supportive for general usage of USDC. Also, when Binance relisted USDC pairs as well towards the end of 2023, I think it was at the very end of 2023, that's also been quite helpful. But of course, the big story still tends to be the Bitcoin ETFs. And I think that those flows and renewed interest in the crypto ecosystem has certainly been the biggest driver. But I think that all of this is part of the reason why we've seen a lot of that happen. We've also have a Coinbase program for market makers, which is also incentivizing a lot of the activity on perps and spot right now.
Yeah, those teams doing a great job across the board, and great to see that more AUM increase and usage grow as well. Now, we'd love to bring in Sid, but I want you to stay with us, David, for a second. So you mentioned blobs, and if I understand correctly, and Sid, keep me honest here, that's essentially going to, and David, keep me honest as well, that's going to reduce the transaction cost on L2s once that goes live. Now, if that's the case, what are some of the things that maybe we can do tomorrow, or rather post March 15th upgrade, that we can't do today?
It's really just a matter of, making transactions on chain. For a lot of these L2s, they, especially rollups, they kind of batch their transactions and they submit them. And the part of this whole process that's getting cheaper is the data availability layer. So Celestia is known for this. They've been campaigning with several L2s to onboard them. But what these blobs do is it effectively offers a kind of base Ethereum level storage unit called a blob, where L2s can post some of this data, making it a lot cheaper because the blobs can fit a lot more data. And so just an average transaction on Arbitrum or Optimism or on Base will just get cheaper by default as L2s post more data to these blobs. So pretty much anything on chain on an L2 would become technically cheaper, but it also enables apps that take advantage of this potentially to have more high throughput kind of transaction flow, similar to what we see on the likes of a Solana or other chains.
Interesting. And David, how about you? You've been thinking about this a lot. Like, what application would you like to be seen built with this that we couldn't build today, for example?
I will admit my ignorance on this side, Ben. And what I mean by that is I think that this is probably going to enable things that we haven't seen before, but I can't really tell you what those are because I haven't seen it. I think that this is going to be interesting, particularly in line with everything else we're kind of getting in the crypto ecosystem right now. You know, I'm talking about like more privacy enablement through ZK or FHE or things that we're seeing in terms of like EPIN and the intersection between AI and crypto. I think that there are some big opportunities that we're going to get on the side that might be enabled. But I'm just kind of waiting to see what kind of comes out of it.
Yeah, I agree. I think it's super exciting. It's similar with AI. There's just new things that we can do that we haven't even thought about, but we just have to wait and wait for the technology to evolve. Sid, what else in Web3 have you been keeping an eye on? Are you still playing with Farcaster, and what can we expect from that team who continue to ship incredibly well?
Yeah, absolutely. A lot of interesting developments on that front as well. Last week they added Solana verified address support. A significant portion of people have verified Solana addresses on Farcaster now. And then today they released a spec for supporting transactions within frames, so on-chain transactions. So this could potentially be interesting as frames, as we covered in earlier calls, are kind of mini apps within the social feed. But these apps are just returning images and data. But if you can support transactions, then as people are scrolling and having these conversations on the social feed of Farcaster, they can also interact with DeFi or mint NFTs or do any other arbitrary on-chain action from the feed itself. And in combination with the wallets being linked there and transactions being possible via frames, it kind of short circuits the entire kind of account abstraction narrative in a sense, because this is kind of account abstraction in action, where you have multiple accounts linked to a social account, and then that's via that social account you do all your on-chain activities. So a different paradigm for how we look at interacting with crypto dApps, just a different approach being taken by Farcaster. Wow,
that's incredible. Yeah, I hadn't really thought about it in terms of the account abstraction side of things. Does that mean, I guess, if Farcaster gets sufficient support within the community and growth, then maybe others won't require the need for formalized account abstraction as that goes live later on in the year? Is that fair?
Exactly. Yeah, it's more of an interface play. It's kind of owning the user. There's obviously a big battle here to own the user and own the space of where users are actually interacting with crypto. So potentially this is one path where the social feed becomes the central venue where transactions are to be had. Even today, Uniswap released a browser extension to have a wait list open for their browser extension. So, there's an angle from different places, from the mobile, from browser extension perspective, and then from the social feed perspective, all looking to own the user. And so obviously pretty fierce competition for this.
Yeah, I will say anecdotally, I was communicating with a few people on Twitter yesterday or X, and the alternative was to use LinkedIn, and the speed of response you get on Twitter versus LinkedIn obviously depends on who you're speaking to, but I just felt like it was orders of magnitude quicker certainly for those in crypto. And the user experience I felt was much better as well. But anyway, that's just purely anecdotal. Sid, anything else in Web3 that we should be keeping an eye on? Any big dates? Other things that are important?
The other kind of big debate that's been happening in Web3 has been around Athena, their kind of stable coin project. A lot of debate around this, around the kind of mechanism stabilizing this, etc. It's probably something we'll dive into in more depth as it gains more and more traction. But it is a project that's been garnering a lot of attention, especially because of the kind of novel mechanism they're using to achieve stability and whether they can retain stability or not.
And do you mind just giving us a quick rundown on how they do that?
Yeah, absolutely. So basically, Athena has this thing called the internet bond, and what they, the kind of stable coin around that is called USDE, And basically, what they do with this is, why it's even interesting for folks is, it's got a yield of 27% currently, APY, and people have drawn parallels to Anchor from Terra with this yield. But what's been interesting is how they kind of actually get this yield, because basically folks kind of deposit a variation of a liquid stake derivative. So currently staked ETH as collateral for the stablecoin. And basically what Athena is kind of trying to do with this, synthetic USDE is have kind of a delta hedging derivative position on the collateral held, and kind of maintain stability through that kind of hedging on the back end. And there's been a lot of debate about the complexity of this hedging, whether it's reliable or not, and also what would happen if STETH or ETH itself kind of has significant volatility, and whether that would impact the stability of this coin. So potentially this is also something Shiliang has thoughts on.
Yeah, Shiliang, I think, curious to understand how you think about this.
Yeah, I have a pretty interesting anecdote about Athena, just because I'm an investor and generally just follow the protocol and just the other day, right? Like, Basis has been kind of blown out across the board in Ethereum in this run up. But even just the other day, you can kind of like track also just on chain a lot of movement. So like when you get like a large deposit into like an Athena, wallet address, obviously they have to basically leg into like this cash carry basis trade. So you can actually see like there was one instance, a couple of weeks ago when basis on ETH in Deribit was something like 30, 40, 50% annualized. And, they saw like a large deposit and basically that got basically converted into this, cash carry like basis trade. And it actually like effectively like crushed the basis rate on Deribit like intraday when that deposit hit. And so I thought that was pretty interesting. And now that I think like Athena is like something like 3 or 4% of like global perp, like open interest, which is like huge, right? That's like a huge feat given they just launched. And so they're definitely going to play a big role in shaping like the derivatives market going forward, as well as like how their positions, flows in and out affects like the basis and funding rates, across the board.
Wow, isn't it incredible to think like the user experience that they've created allows people that couldn't otherwise trade basis. And that's why it gets to 3 to 4% of global OI so quickly. Is that a fair kind of summary?
Yeah, I think in general, like, it's one strategy, right, that, gives you yield, a healthy yield in this environment. For those that don't have the sophistication or tools to leg into a like cash carrier or basis trade, like it's a pretty easy like way of doing it, right? Just with a couple of clicks of the button, basically you get that exposure. And then on top of it, Athena is going to launch a token, right? They're having the point system now. So you also get the additional juice from like Athena token yield in the future.
Oh, interesting. Thank you very much, Sid. Shiliang, final question for you. What is your outlook for the rest of 2024? We've had a pretty amazing first couple of months of the year. What are we looking out for the next 10 or so, do you think?
It's probably going to sound, I don't know, boring or cliche, but I think like generally don't overthink it. I think it's like it's shaping up to a pretty good year of, hopefully the Bitcoin ETF continues to drive inflows. Hopefully we get the Ethereum ETF as well. They'll obviously drive, further inflows into that part of the ecosystem. I think in general, like a lot of allocators that we speak to are starting to, like that, previously exited the space post FTX, are starting to allocate again. So I think there will be a lot more inflows, and then hopefully the macro side with the election and rate cuts hopefully in the second half of the year, that will further drive like risky assets forward, right? So I think in general, hopefully it's shaping up to be very similar to 2021. Yeah.
Amazing. Well, with that, we're going to call it a day. Thank you, Shiliang, for joining us. Great to have you on. Thank you, Greg, David, Sid, and our fantastic production team. And everybody enjoy your week, and we will see you next week. Take care.